Hey everyone, I hope you're all doing well out there. This is your August market review. For those of you that haven't watched these videos before, the reason I put this video together each month is to give my clients the straightforward information about what's going on in the stock market, the economy, and then ultimately how that affects their investment portfolios that I'm helping them manage. So what I do is typically I'll go through a handful of charts to help kind of really just depict what's going on in the stock market or economy, just because I like using good visuals. Investments and financial concepts a lot of times are very abstract, so putting some sort of visual to it I think is impactful for both my clients. I like it just because I think that pictures kind of really help digest the information about what's going on. So I have a few charts here, and then I have one investment idea that I'll go over for people that have money that's sitting in savings or low interest bearing accounts. I'll go over that idea here. So if you have money that is sitting in short-term savings, CDs, short-term type of accounts that you'd like it to make a little bit more, I'm going to go over an idea that'll be really applicable for that money there. So first I have a chart showing the S&P 500 over the last 5 years, going back through 2020, which at the time this was the rebounds after COVID. The market had rebounded back in August of 2020 to its pre-COVID highs. And then you can see the chart moving up into 2022, dropping off in 2022, and then moving higher from there. So right now we sit at a market high. I bring this chart up because it's something for, and I really only get kind of a good glimpse of what people are thinking about the stock market and economy when I'm talking to either my current clients or prospective new clients. Because me being in the weeds every day, I know that the market's at an all-time high or close to it, but the perception that people get of where the stock market is always interesting for me to hear from other people, because I've had a lot of people recently say that stocks are struggling right now, which obviously is coming from more of just a point of opinion versus actual facts, because we're looking at them with the chart. And a big part of that actually, I looked then, just because I've been hearing this a little bit more over the last couple months, that stocks have really been struggling or volatile, which there was some volatility in April because of the announcements of tariffs, and then there was the rebound that resulted in that. But really, if we track going back through really the bottom of 2022, and we were to draw a line, which I'm going to draw a line in here for you just to kind of depict the trend that we're following right now. Even with some of these dips below the trend, we've gotten right back on trend of where the market is heading. And that's after we had this break of a trend in 2022. We went through a downward trend for a period of time, and then that broke trend and set a new trend higher. I'll show you a line in there for that as well. You can see in 2022 that line there where all of a sudden we broke trends and then moved lower into October of 2022, and then markets rebounded, kind of retraced a little bit, and then started moving higher directionally to where we are today. Even with that break of trend in April, we got right back on trend pretty quickly after that. So, I don't really expect us to be, there's nothing obviously, foreseen right now that is going to break trend with that. One of the big signs coming up is that, on a positive thing, is that the Federal Reserve has announced that they're looking to start cutting interest rates, or at least, strongly considering it. So that's definitely a very helpful thing. But another chart I have kind of looks at the sentiment of investors out there, which kind of goes into what I've been hearing a little bit more. And I look at this occasionally to see there's a investor sentiment that's that really takes into account. I forget exactly how many people vote on this, but there's a lot of people that they get in this study where they poll investors of what their sentiment is, either bullish, neutral, or bearish. Currently, as of kind of the end of August here, the sentiment has been more bearish. There's 45% of people as of August 20th that are in a bearish sentiment. Only 31% would be bullish. The rest are neutral. Generally, this is a more this chart kind of is more like, well, this is where people are thinking right now, which generally the opposite ends up happening, where if there's a lot of people that are bullish, that means the market may end up either pausing or dropping off. Bullish just means that people are assuming that they're very positive on the market. They think that stocks are going to move higher. Bearish is the opposite. They think that stocks are going to move lower. So when there's a sign that people think, and especially when there's a lot of people that think that stocks are going to move lower, it's actually more of a contra-indicator pointing towards stocks possibly, more than likely moving higher and vice versa. So you can see some of the historical levels. Generally, people are on average more bullish 37% of the time than bearish 31% of the time. Right now, we're 14% higher in bearish, which is a good sign, really, that stocks are likely to keep moving higher, at least in the short term, because of the negativity that's out there, which is one of the signs that I've been hearing. That's a good sign for us moving higher. You can see even the recent highs of bullishness was about a year ago. The high for bearishness was back in April of this past year when there was 62%. That was after the tariff announcements, which we can see what happens. I'll pull that other chart back up here, the 5-year. You see circled it there, that drop in the stock market or the S&P 500 in April. Not surprisingly, there was a lot of bearish people then. That's a great, that was a great indicator at that time that it was time to become more bullish, though, because of how far stocks have dropped. So I use this as just like an indicator to kind of get a general idea of where investors are at. So I thought that was a good chart for people out there that might be on that more bearish side and feeling negative for whatever reason about where the stock market's at, or concerned that we're at highs and it's going to go lower. Give you kind of at least something you can sleep easy on, and at least a little bit of where my head's at with things in the short term. That my feeling is that stocks are moving higher, and for some of the reasons like interest rates moving lower, and the fact that there's just a lot of negativity out there of other investors thinking that stocks might move lower. Generally, that's a contra-indicator that stocks are likely to move higher. So a couple charts I thought that were interesting there. Another chart I have here is a bar chart of the S&P 500 going back through the 1920s. This is I want to just give some of those people that are thinking maybe negatively about the markets, or just maybe don't have like historical idea of, well, what do markets typically return and where are we at. Typically, the average over time is 8% returns for the S&P 500 on a price basis. On total returns, if we included dividends, the returns are actually closer to 10% typically. But if we're just looking at the price of the S&P 500, it's about 8%. That doesn't include dividends. But the last couple years, this goes through 2024. It doesn't show this year yet because we're not, through a full year yet. But right now we're at about 10% on the S&P 500, which the average is right about 8%. We're kind of right at average right now. But the blue on the top gives you a good idea of, most of the time stocks are higher. 75% of the time stocks on a year-over-year basis are higher. There's those years that, like 2022 where they're lower, or 2018, in more recent years where they were lower. The big drop-off was during the great financial crisis, where stocks were down 37%, 38%, and then you can see some of the other years in there. But there's a lot of years where typically it's higher. One of the things I always like showing is, if we were to cut out even just the 10% drop, if you do a kind of cover up the bigger drops beyond 10%, most of the drops are within that 10% range, or you're maybe not that much further. 2008 was one of them that was a lot bigger, 2002 before that. Then you have to go all the way back to the 70s where there was bigger drops, more than 10%. But And then prior to that, you really have to go back to the Great Depression where there was bigger drops. But if we eliminate a lot of those 10% drops, which, if you work with me and we have money a little bit more conservatively invested, we use some of those options-based strategies to eliminate some of those downside drops in the market instead of using bonds. That's one of the reasons I do that is, using those tools. Typically, we don't have massive drop-offs within the stock market. So if we can eliminate that 10 to 15% of the downside, historically, that's eliminating the majority of the drops out there. So I just wanted to bring that to your guys' attention because I thought that was a good chart, really just to kind of depicts where things are at and historically where we fall in. Okay, last chart that I have here is going into an investment strategy that it would be is a really good tool that I like using for people that are investing money in short-term types of investments. It's a little bit of a step up from just leaving money sit in short-term savings or CD or a money market. It's not guaranteed like a CD or a money market or a short-term savings account because it is an investment. With any investment, there's potential for investment loss, yada yada. Everybody knows that investments carry potential for loss. So this, though, eliminates a lot of the potential for loss because it's an options-based strategy, similar to what I use for people that are a little bit more conservative in their IRAs to replace bonds. This is a tool that I use in a lot of taxable accounts I refer to as a middle bucket for a lot of you out there. If you're a client of mine, I've probably talked about middle bucket money. This is money that you're not planning on using within the next handful of months. You don't want to leave it sit in your savings account where it's not going to make anything, but you also don't want to lock it up maybe in a retirement account because you might want to use it, in a shorter time frame. But this is something that can get the money invested and growing a little bit more on the upside while eliminating, a big amount of potential for loss on the downside. So the way that this strategy works, it's a quarterly buffer strategy. So it is linked to the S&P 500. If the S&P were to drop anywhere from 0 to 20% over a calendar quarter, we don't lose anything within the strategy itself. If the market moves up and, like it has so far this quarter, the market's up about 5% for the quarter. The fund is up 1.6%, at least as of, today when I'm shooting this. The cap on this is 2.4% for the quarter, meaning that if stocks were to stay where they're at right now or even actually go down even 2% from where they sit today, if you were invested from July 1st through September 30th of this year, you'd make 2.4% on that for the quarter. This is a good strategy for people that want to make a little bit more than a money market or CD can make, are willing to take a little potential for risk if stocks drop more than 20% in a calendar quarter. Can happen, doesn't happen very often, obviously because that's a very big drop in a short period of time. But the way that would work is, say that stocks are down 25% for the quarter, you'd be down the difference between 20 and 25, which would be 5% there. So the way that this strategy is created is using call and put options that are inside of the fund itself. If this is held for over a year, one of the benefits behind this, because it's an ETF, is that it gets long-term capital gains treatment if it's held for over a year, which when we're talking about a taxable investment account, if you hold an investment for more than 12 months and a day, you get long-term capital gains treatment on it, meaning that you're going to pay, for most of you out there, 15% capital gains, versus if you have short-term capital gains, that's where you hold it for less than 12 months. Your short-term capital gains rate is always higher than long-term. Typically, that's at your ordinary income tax level. So just the way that you're able to save a little bit more in taxes potentially, control the taxable event because you don't pay taxes on it until you sell the position, and get more potential for upside because theoretically you could have 4 quarters in a row where markets are up and you're making 2.4 or whatever the cap is for that quarter, each of those quarters. So like in 2024, for example, the gains on this strategy were 10% for the whole year. So a lot more upside than what you would have gotten putting it in a CD or a money market or a high yield savings account, and getting better tax treatment on it, because if you're making money, if you're getting 4% on a CD, that 4% interest is counted towards your income. So that income is always taxed at a higher rate than capital gains tax. So food for thought for anybody that is out there that has money just sitting in savings, whether that be in their personal investment account. Business owners, great tool for a business that has money just sitting in the business account where they're not planning on using it for any short-term needs that are coming up. You can open up a business investment account just like you can a personal investment account and have that money invested for the business. Same reasons you would do that, because you want to make a little bit more on that money than just leaving it sit in savings. So I thought that was just an idea. I've come across that a lot over the last few years, and I try to talk about that from time to time with my clients as far as getting their money working for them. More you can get your money working for you, the more money ultimately you're going to have just by putting it in the right places. So I thought that would be a good idea, kind of timely, just because of interest rates going down. Likely next month, that means that CD rates are going to go down. High yield savings account rates are going to go down. All of those will kind of go along with that. So I thought that would be a good idea for anybody out there that might have some money just sitting in savings or CDs or whatever it is, to get that money working a little bit better for you. So appreciate you all taking the time to check me out. If you have anybody that you think would be interested in having a conversation with me, don't hesitate, have them reach out to me. If you're a client of mine, just put us in a 3-way text. That's probably the easiest way to get us connected. If you have any questions, don't hesitate, just reach out, call, text, email. You'll be happy to set up some time to talk a little bit more in depth. But appreciate you all taking the time to check me out. Until next time.